All right, guys, welcome back to We Talk Money. Still so much to talk about in the crypto space with the fallout from the FTX situation, which we covered a lot last week. But Trav, you had a great tweet storm that I just want to jump into talking about GBTC. That seems to be the big question on everybody's mind. So we'll talk about that. We've also got some economic data that are showing that some of the tides could be turning. China's going crazy with COVID stuff still. Elon Twitter situations heating up. So much to talk about, but how are you guys doing?
Great. All good. It's like holiday season hitting in the US. I've got the Christmas music hitting the radio now. I'm pretty excited.
Are you listening to Mariah Carey yet?
I've definitely
All
heard
I want
some
for
Mariah
Christmas
Carey.
is you.
Oh yeah. I love those memes where it's like, they're breaking Mariah Carey out of like storage or whatever for the season.
Oh, it's so great. It's so great. I love this time of the year.
Yeah.
It doesn't really feel like Christmas here in Asia. It's still like 95 degrees Celsius, hot as crap. So
yeah, well, I was surfing in Hawaii this past weekend, so it's not like it totally feels like Christmas here, but at least we've got like some little things here and there. You've got people shopping like crazy. Target parking lot's full. So you see it there.
Yeah, it's going to be interesting to see what happens this holiday season with retailers. You guys know I'm interested in all of that stuff, but
yeah,
there's been a lot of like gloomy stuff in the news about that, and Black Friday sales was like kind of a mixed bag depending on the retailer. So some interesting stuff.
Yeah, I want to hear your thoughts on that. You're like our retail guru, and you've like owned some of the best retail stocks of the last like 5-10 years. So I definitely want to get your thoughts on that.
It's funny. My Ulta stock is a hedge right now. It's the only stock making all-time highs. It's like I looked at it yesterday. I was like, whoa. I'm hedging, I'm just over here hedging with my beauty stock.
Nice.
You've got your Lulu and your Ulta horses just chugging along.
Lulu too. Yeah. We'll get into all that.
All right, let's do this. Let's jump into Travis's GBTC tweet storm, which got a lot of traction here. This is the big question, right? Like FTX screwed everybody, and the fallout and the contagion has just sent ripple effects through the crypto space. And the largest risk I think that people are looking at now is GBTC and trading at just like epic discounts to the net asset value. And Trav, you did kind of a deep dive on this, and I want to talk about what the situation is for anybody that just doesn't know, and what the risks are and what you think is going to happen, and maybe if there's any smart plays that you see around this.
Yeah. No, it's a fascinating situation because of a couple of different components that you just mentioned, right? The FTX situation. Now everyone thinks that everything else is the next FTX, right? Because we've got some bad actors in crypto, and we have several entities this year that have gotten over leveraged and did stupid things. Now everybody is looking at who's next, who else is doing it, who got over leveraged, who's got liabilities that are cascading in their own balance sheets. And so we know that there has been trouble, for instance, at Genesis Trading and at Genesis Global Capital, which are subsidiaries of a company called Digital Currency Group, DCG for short. And of course, DCG owns a company called Grayscale as well. I'm glad you pulled up that slide because I tweeted that one out. I actually made that graphic myself. So if you see it anywhere else on the internet, that was made by me. But yeah, no, I mean, it's interesting because Digital Currency Group, as you probably know, if you're involved in crypto, is, this massive entity that owns stakes in a ton of different entities across crypto. It owns Grayscale, which has all these different publicly traded trusts, which supposedly own a lot of crypto assets. Of course, GBTC, the Grayscale Bitcoin Trust, is the biggest of them all. It owns $10+ billion worth of Bitcoin, allegedly, right? And then, of course, Digital Currency Group also owns Genesis Trading, Genesis Global Capital. And those entities, Genesis in particular, have been in trouble because of some exposure to those companies like not only FTX, but also Three Arrows Capital being another big one they had loan exposure to. And so there's all this, intercompany liabilities and assets between the parent company, Digital Currency Group, Genesis Trading. And that leads a lot of other people to worry about, well, what might Digital Currency Group be doing to try to plug holes? Could they be messing with Grayscale? Because we have all these publicly traded trusts like GBTC. And GBTC, I thought, was fascinating because it's trading, or it was trading at a 45% discount to the stated asset value, its stated Bitcoin holdings. And so, you know, it was something like $15 a share last week of stated Bitcoin holdings per share. And yet the thing's trading at, you know, under $8. And what's interesting about that, obviously, is that if Bitcoin price doesn't move and that discount were to somehow get closed, you know, if GBTC's price went back up to the net asset value per share that it should trade at you know, parity, it would be a $15 stock. And so you almost get a double out of the stock if it were to close the discount. Now, the problem is, do the assets exist? Do they really exist? Have they been messed with by Grayscale or Digital Currency Group? These are all the questions that I kind of sought to answer. So the tweet thread kind of walks through, you can go read that tweet thread. I'm not going to go through all the detail here, but you know, basically it was me reading deeply through all of the documents of Grayscale at the Grayscale Bitcoin Trust, trying to find as much information online about Digital Currency Group, articles that have been written, investing articles that were written about the capital that was raised by DCG, articles about what happened at Genesis. Genesis publishes quarterly reports publicly, so I read through some of those. Anyway, long story short, you know, I actually came out thinking that the Grayscale Bitcoin Trust actually probably does own the assets, and it is probably safe. No matter what happens to Digital Currency Group and Genesis, the assets are kind of firewall because they are custodied through Coinbase custody. And there is some small risk out there, obviously, that Grayscale in conjunction with Coinbase could have lied about the assets, or, you know, could have not custodied them properly. If that is true, though, then Coinbase is a zero. And Coinbase is, you know, a $10 billion market cap company as well still. And, or maybe it's 8 or 9 billion after last week. But, you know, this is a serious allegation, right? If it were to be true that the Grayscale situation or the DCG situation was similar to FTX, then you have a lot bigger problems than just Genesis, DCG, Grayscale. We're talking about an implosion of one of the largest exchanges in the world. We're talking about full loss of trust in the system, not just FTX. I mean, I think that would be, if Coinbase were to be, you know, zeroed out, I think overnight, that would, I think, be even more of a mortal blow, so to speak, than the FTX situation. Anyway, I've been talking for a while, but happy to talk about any of the angles there. But I actually bought some. Great. Yeah, I actually bought some GBTC, by the way, last week, full disclosure, because I like the risk reward when it's trading at a 45-50% discount to the value. And I think the assets are there. We have some proof that at least half of the assets are there. And I think the way that it's legally structured is actually beneficial. And I don't think the trust can be touched by DCG or Grayscale without essentially breaking significant laws. And you know, these entities are also domiciled in Delaware, not in the Bahamas. And so there's a lot less room for the type of shenanigans we saw at FTX.
Yeah, I think rightfully so. People are really skeptical right now and fearful. And I think, you know, it's smart to do basic things like we've talked about, like get your coins off exchanges. But there's also a fine line between like looking at actual risk in the system and FUD, right? And that line gets really grayed in the crypto space a lot. And it's a lot of times you just don't know what the inherent risks really are. You have to trust centralized entities. And that's kind of the problem that Bitcoin's been trying to solve. But the ecosystem that's been built around Bitcoin requires trust in these systems, right? And so, yeah, I don't know. It's just interesting to see how there were just like blatant lies and FUD that came out around GBTC. And then there's also like guys like you that were putting out information saying, hey, here's what I think the reality of the situation is. And here's maybe what the risks could be, but it doesn't look as potentially as bad as everybody's making it out to be. Would you say that's kind of an accurate summary?
Yeah, absolutely. And I don't deny that there's problems that I think, you know, even DCG has come out saying that there's problems at Genesis Global Capital, Genesis Trading, you know, at DCG, the parent company itself has assumed liabilities from some of those subsidiaries. So there's no question that they are facing some issues that they need to deal with either through capital raising or, you know, maybe the restructuring or some infusion of capital, whatever. But that doesn't mean that the Grayscale entity, which is just a sponsor to the Grayscale Bitcoin Trust, is being rated the way that FTX was. Now, FTX was bad. I mean, look, we all had probably a lot more faith that that type of a firm, that type of an exchange that had the type of blue chip investors it had, you know, there's a reason that confidence was shaken because of that. But again, it does kind of remind me of 2008, 2009 in the banking system when after Lehman failed, after Bear Stearns, after Lehman failed, everybody started playing the hot potato game of who's next? Is it Goldman? Is it JP Morgan? Is it Bank of America? Are they all going to fail? And the reality was they didn't all fail. They weren't all like Lehman. They had more options. And so there were opportunities, like we bought some Bank of America stock at the hedge fund at like $4 a share. And it was trading for 0.2, 0.3 times book value. So that's the type of price you can't get except in an environment where everyone's questioning everyone else's solvency. But if you can do the work and get comfortable, it may not be 100% confidence in, for instance, like GBTC here, but if it's high enough and the risk reward is good enough to pay you for that, then I think, there can be some interesting opportunities. So. Yeah.
And I guess the question is this something that you would hold long-term, or is it just for a quick bounce play to like close the NAV? Because you've got the 2% fee, and like, I question, like, why does anybody actually buy through that instead of just buying spot Bitcoin, which there's obvious use cases, but how are you looking at this?
Yeah, I only like this trade because the discount got so wide, and it could widen further, frankly. So it's not a perfect vehicle. If I wanted better long-term Bitcoin exposure, I think owning Bitcoin itself is a better play. So this is definitely more of a tactical trade with like a 6 to 12 month horizon. And I think there's a decent chance that the discount could get closed a couple of different ways. And that would be something like, for instance, Grayscale being sold to another asset manager like Blackstone or someone like that, that might actually even have more sway with the SEC, for instance, to change the type of investment vehicle. By the way, there's also a potential here for them to actually be able to close the discount because they can appeal to the SEC to do like redemptions. And so it's not something that Grayscale necessarily wants to do because they are earning that 2% a year fee, which it's 2% of net asset value, by the way, not 2% of the market value. So the 2% is actually even an even higher fee when you look at what it's taking as a percentage of your market value. So that fee is kind of a problem. Point. But yeah, so to answer your question, look, it's not the best vehicle for long-term Bitcoin holdings, in my opinion, but because the discount's so wide and there could be potential catalysts in the next year or so to close the discount, I think I like it for that reason. But it's a small position for me, just full disclosure, not something that I'm going super, super heavy in.
Yeah, man. Thanks for doing this deep dive on this. I know a lot of people got a lot of value out of it, and it's such a weird time right now because I think it's like the tide went out and the emperor has no clothes, and we're seeing the fallout from all of this. Just the crypto casino and the house of cards DeFi yield farming bullshit that people thought that there was such a thing as risk-free yield, and we're seeing that that's not true. And now this week BlockFi just filed for bankruptcy, and we could talk a little bit about that, and the implosions just keep hitting.
I think back a lot about when I was hearing about the BlockFi news. It was like, we knew it was coming, but we got a lot of messages from people when we were doing the show, back when it was hot and everybody was promoting it on their podcasts, and the founder was out spreading the news and spreading the word and trying to get people into the ecosystem. But a lot of people were messaging us and asking us about putting their savings into BlockFi because of the yield. It was so attractive. Yep. And we probably looked like real losers back then, saying, no, do not put your savings into BlockFi. Savings belong in a high yield savings account that's safe. And, we probably looked like real squares. But this is what we were talking about, is that this did not come without major risks. When you have high yield like that being guaranteed or being promoted, that comes with significant risks that a lot of people just couldn't see through the big percentage on the screen, right? And so I think that, yes, we did like squares, but we saved some people life savings, their emergency savings, into these types of accounts.
Yep. Yeah, I mean, I know we've talked about that quite a bit, and BlockFi actually reached out a couple of times wanting to do some kind of sponsorship, and I just said no from the beginning. I didn't even want to entertain that. I've never promoted FTX, any leveraged futures thing, anything that I thought just had too much inherent risk, right? Like I've got an affiliate link for, like Coinbase, which they pay, I think like $10, it's not a split of fees or anything like that. And I think by avoiding these things, hopefully we have saved people from losing a lot of money. All right, so let's go ahead and dive into some of the economic data that I think is pretty interesting. We can talk about Bitcoin and the chart here in a second, and also like where the stock market's at. But to kind of give that stuff a little bit of context, let's talk about, unemployment. Let's talk about housing and kind of how these things are tying in with the stock market prices. Nick, you want to take this one?
Yeah, I think that a lot of people are paying more attention to the economy right now, probably than they ever have. Inflation's in the news, layoffs are in the news, and everyone's wondering if we're going to be going into a recession or if we are in a recession right now. And so, with the unemployment data, the initial jobless claims, which is basically people coming, new to the unemployment office and requesting for unemployment because they lost their jobs. And we are seeing that tick up. Obviously, we've seen a lot of news about layoffs, more on the tech side, but we are starting to see that reflect with initial unemployment claims starting to tick up. However, they're still very low. I mean, if you actually zoom out on that chart, Chris, and go to like a 5-year or a 10-year, I mean, you can barely, see it because we're still pretty low. But it's something to pay attention to and to watch. Obviously, that's something that's very important to the Fed is the unemployment rate. And that's going to kind of help them gauge how they're going to go with interest rates going forward. But it's just something to note. And then also, that means weakness. And then also housing prices are rolling over, which is a good thing, I think, for a lot of people because things got out of hand. So I don't really see the housing prices rolling over as a negative. But obviously that proves that what the Fed is doing is working and the economy is slowing. One thing that I find interesting is that retail sales continue to be pretty resilient. Now, I'm starting to see some bifurcations as well. Like in retail earnings, I noticed that some companies are a lot stronger than others. And there were things that, like, for example, Walmart had strong earnings. They were noticing the consumer was coming to them more for essentials. Target, on the other hand, earnings were not good or not great, and they are seeing a hit. The consumer is not buying throw pillows for their couches as much, or they're not buying, discretionary goods or clothing as much in the Target stores. So that shows that the consumer is starting to change habits, which we knew was a potential thing that was going to happen. But at the same time, we're also seeing strength in other retailers. So I'm starting to see bifurcations again, kind of like we did during COVID, how there were winners and there were losers. We're starting to see that significantly in retail as well. Lululemon, for example, freaking a banger still. Like, they came out and had their Black Friday apparently did really well for them. Ulta, banger, still, putting out great comps, sales comps. So we're seeing, but then on the other hand, we're also seeing other companies like American Eagle that are kind of floundering. Hollister is a brand that's floundering, but on the other side, you've got Abercrombie and Fitch, which is doing extraordinarily well considering where they came from. So we're seeing the consumer still spending discretionarily, but they are picking and choosing very carefully. And I also think that the higher end consumer is still spending a lot more than the lower end consumer, which is to be expected. But we're seeing it in the earnings.
Are you seeing like luxury brands are doing better than, like the Targets of the world? So is it the high end luxury brands that are, their earnings are just staying strong where everything else is flat to down? Or is there a different thing?
They're the lower end consumer, they're getting the hit, right? Because they're the ones that are going to be spending discretionary, just using their discretionary income in a Target, right? They're going to Target to spend their discretionary income. But Target says, we're not seeing that right now. We're seeing people pull back. They're not spending on discretionary items as much. But then on the other hand, you have Lulu, which has a higher end consumer. You have Abercrombie and Fitch, which is a higher end consumer. Luxury brands that they are seeing people spending, but they typically have, maybe that higher end consumer that can take the blow of inflation, and they maybe are not seeing the effects of unemployment and things like that. So I also think that there's more debt being taken on by consumers. That's in the data too. But right now, I think go ahead. We're in this bifurcation again.
Yeah, it seems like from what I've read through the transcripts as well from the retailers that have been giving out comments and some of their results over the past week or two, it's like the high-end consumer is still doing great. Like they don't seem to be phased. At the low end and in the middle of the distribution, like middle of the distribution is being hurt pretty hard by inflation. And so they're starting to trade down. So you're seeing like retailers, for instance, like Walmart doing really well, but then you're also seeing like the high end doing really well. So there's like this barbell of like high end is still doing great. And at the low end, you've got middle income consumers trading down to some of the lower end retailers, like your Walmarts, your Ross stores, your TJ Maxx's. So it's like the ones that seem to be like the worst position would be like kind of the ones in the middle. So the ones in the middle are not getting the trade down from the middle income, and they're not really getting the bump because of the high end consumers are still shopping high end. So it's like this weird bifurcation is a great word that Nikki used, I think, to describe it.
That's kind of what's going on with like American Eagle, right? Versus Lulu or Hollister versus Abercrombie. Like that's what we're seeing, exactly what you just said. So retail is not dead. I think that retail is not dead, but you had to pick the winners very carefully here.
I think what's the big argument right now too is like, what is it just that we haven't seen, like we actually are just still on the front end of this like tipping into recession, because for instance, people have been spending down their savings, which got to like excess levels in the past couple of years. And now we've seen the personal savings rate trend down. We actually get more savings rate data, I think, later this week. But the savings rate has been trending down. So some people at least have been spending down the excess savings. So that's been helping to buffer. Then you've got still relatively low unemployment, although we've seen obviously more layoff announcements. So it's like we think a rise in unemployment's coming, by the way. We get another unemployment report on Friday. But it just hasn't showed up yet, and consumers remain relatively resilient. And so like this recession that everybody is sort of like expecting just hasn't really hit us yet. But a lot of people think it's still coming in 2023 because we will see the uptick in unemployment. We will see consumers stop being able to spend down the savings balances, whatever. And it's TBD. I mean, there is a super inverted yield curve. The bond market certainly believes right now that like recession is coming. And I mean, oil prices kind of look like maybe they're expecting demand to weaken, and tech companies are laying off people. So you do have like some signs, but it's still very muddy out there to figure out if we're going to have a soft landing, just like a very shallow, correction, or if it's going to be like deep recession because we just haven't gotten to it yet. You know what I mean?
I did want to bring up the China situation, because I do think
that was my next question.
That bleeds into not only markets, but it bleeds into the economy, because a lot of
supply chains.
And here's the thing, and Trav, this is a question that I was going to ask you. So I was on a Twitter space this morning, and I was listening to somebody who will remain not named, that they heard from a big investment firm. They were in an interview that China could end up locking down, heavy lockdown, because of COVID spreading exponentially for like 3 to 4 months, and the market is not pricing this in. And he was like waving the red flag, and like markets are about to be potentially in turmoil, and the market is like trading, the S&P is trading as if this isn't going to happen, and that it's not pricing in the risks of China shutting down for an extended period of months. And it got me thinking, and I was like, okay, China's already shot themselves in the foot, and the market has already priced in a lot of China being offline. But like, what does that look like, and what are the odds of China shutting down completely for like 2, 3, 4 months? And what would that do for stocks, for U.S. stocks at this point?
And for anybody that's listening, that's like, oh no, they can't do that. That's crazy. Check this out. This is a video that I found on Reddit that's showing in Guangzhou. I don't know how you say that. One of the biggest cities. They're building a 90,000 person. What do you call this? Like a containment facility for people that are in quarantine. It's basically a prison with tens of thousands of units. So yeah, they would absolutely do it. And people are revolting. And you know, we've all seen the videos of like the journalists getting accosted by the police for trying to report this accurately. Like, it is definitely not out of the realm of possibility that China could and would absolutely do a complete lockdown or just overstep. I mean, they're already doing it, but yeah, what are the probabilities of this just absolutely knocking the S&P upside the head?
I mean, I certainly think, yeah, I think it's a possibility. I think, you know, we have such a hard time gathering intel about what's happening in China over here in North America. And I think, yeah, it remains relatively closed because of language barriers, because of like disinformation campaigns, because of all sorts of reasons. But it does seem like obviously there's rising angst. And so I actually don't know. I mean, I think there's a reasonable probability that there's going to be a hard hand coming from the CCP to try to end the protests and really like just try to enforce lockdown because it's winter, because, you know, the cases are rising there pretty rapidly. But on the other hand, at some point, you know, if the angst becomes too much, if too many people rise up, you know, then the CCP leadership may be threatened. And then also you have, you know, the Chinese are signaling that they're making moves to actually try to reduce some restrictions. Like, people forget, we've actually seen more evidence in the last 2 or 3 months that the Chinese are actually moving towards, or were moving towards, like loosening some restrictions as they move into like at least spring time frame of next year. So I would be surprised if like they go ultra full lockdown, but there's still a very reasonable probability that that would happen just based on the hard fist of the CCP wanting to kind of come down on everybody. But the thing is, I don't actually know how much that really, I don't think that necessarily means S&P gaps down. It's not going to be good for global demand. But on the other hand, you actually do help the inflation problem, which has been a real issue for markets this year. So you actually, in the short term, at least have some more tailwinds to improving the inflation problem. And, you know, frankly, like Chinese demand doesn't, I mean, in certain companies like Apple, sure, it's significant, but like for most companies in the S&P 500, it's not that significant. So yeah, I think, I don't know, I'd put a low-ish probability on them taking the hardest core measures and the S&P, you know, crashing because of it, if that makes sense.
So as I was listening to it, I was thinking exactly that. I'm with you. I find it hard to believe. Well, I think that a lot of people in the market have already been pricing in losing China. And we've seen it in the earnings numbers that the, you know, Asia Pacific region's comps are not great, right? So it's like the market has already kind of priced that in. Could it get worse? Yes. But I think that, like you said, the exposure might not be enough to bring it down to levels that are like doom and gloom levels. So I think that it's a risk, but it's not as big of a risk at this point as this person was making it sound. And so, I mean, he was making it sound like the S&P we're going to see another, you know, 30-40% down with this. This is like a huge, huge deal. And I think it was a bit sensationalized. And I think I'm in your camp that it's something to watch, but it's nothing like Apple, like you said, is going to hurt way more than it's, again, bifurcations, right? The theme of bifurcations again. Certain companies are going to feel that way more than others. And a lot of that has already been diversified out. Like a lot of companies have already diversified out their supply chains because they knew that risk with China was there.
One other thing before I forget as well that I think is an interesting tell in this situation is look at Chinese stocks that trade both in Hong Kong and in the US. They are not acting as if there's about to be the hardest lockdown ever and it's going to totally crush Chinese demand. Chinese stocks are actually trading in recent weeks as if they believe the bigger probability outcome is China actually loosening COVID restrictions. So I just want to say that because it's an interesting tell that disagrees with whoever you were hearing on this Twitter space.
Yeah. That's a good point. We need to do Twitter Spaces, Trav.
I know.
Twitter Spaces needs us.
You know, it is funny you mentioned that. I've heard some pretty garbage Twitter Spaces, but there are people on there every day saying some crazy stuff.
I mean, hundreds.
Well, that's the beautiful thing about the markets, isn't it? Everybody gets an opinion, and everybody can throw their hat in the ring and their opinion and their money at situations. And you have to be right.
Now, with that said, quickly, I think that a lot of people are looking at this rally in stocks thinking, whoa, okay, where did this come from? And is this going to last?
Well, it did look like
it's already starting to roll over.
Yeah, we almost tagged the 200-day, and we've come off it. So, I mean, you could technically make the case that view is definitely winning right now.
Yeah, look, I mean, the next few days will be really key on the S&P. Like if we really snap above the 4K resistance and get above the 200-day, that could cause an epic short squeeze. But as of right now, the technical bear trend is still intact. We have lower lows, lower highs, but that can change on a dime. You guys want to talk about Twitter?
Yeah.
Yeah.
Well, I mean, so there's a big battle right now between Twitter and Apple. Apple's threatening to take Twitter off of the App Store because they're, I guess, mad. I don't know. They didn't say, right? But I guess it's assumed because of the policies that Elon's putting in place. I mean, is this a political battle at this point, or what the hell's going on?
It's like, you know, if I said it's difficult for us to know the real facts on the ground in China as an American, it's difficult to know the real facts on the ground when it comes to Elon Musk.
That's a good way to put it, man. I mean, whether it be Tesla, automated driving, or, you know, Twitter.
Yeah. So Twitter is endlessly fascinating to me, though, because, you know, 2 weeks ago, half the people on Twitter on a Friday and Saturday were like, this platform could be down by Monday. And like people were acting like because, you know, so many employees had been let go at Twitter that the infrastructure was going to imminently fail and that Twitter might be in bankruptcy by the end of the month. And I thought that was just insane and silly, but I was laughing about it. I thought it was entertaining. People were like saying their goodbyes and stuff. I was like, oh, guys, come on. You don't really believe that. But you know, I mean, it's been a wild situation. And it's what's crazy to me is that Elon has picked so many fights at once, right? He's got the whole employee situation where they've lost a significant amount of employees, some by design, others probably they didn't realize they were going to, you know, lose so many. And then they've got PR battles that they're facing and losing some advertisers, maybe gaining some others, but there's PR battle there. And then you've got now a battle with Apple, who has the power to remove the app from the App Store if they want. And, you know, Elon will say, oh, if they stand for free speech, they wouldn't do this. But really, the reality is like, hey, man, they have the platform. This is America. It's capitalism. And it's not a free speech issue. Like if they want to take your app out of their own App Store, they can do it. Like they're a private company. They're allowed to do that. So it's kind of funny that it's framed that way. But you know, I do think he has a real point when it comes to like their 30% App Store cut, right? I mean, I've long thought for even when they first launched it, I think, you know, 8, 9, 10 years ago when they launched the App Store, I'm like a 30% cut. You compare that to like credit card processors, which take like 2% of every transaction. And people thought that was nuts and still fight against it. And you're like 30%. And Google does the same thing, by the way. They've started to soften that a little bit. But yeah, Apple 30% cut of all in-app purchases and purchases made in the App Store, and it's just like an insane level of rake. I mean, you don't see that anywhere else. And so I think
it almost makes you think like what businesses could exist if they didn't have to pay 30% of their gross sales to Apple, right? Like a lot of businesses don't even operate on a 30% margin. Like how many businesses could be thriving on there that just can't?
Yeah, you're totally right. I mean, it's wild that level of rake is wild. And you know, we've seen other big companies like Spotify and Fortnite and some of the dating apps trying to fight this. And I think there's going to be a real movement, you know, with or without Elon. I think there is, and there will continue to be a big movement to push back. And Apple is opening itself up definitely to, you know, some regulatory challenges, I think, through that. And so it'll continue to be a fight, I think. And I think at some point they're going to have to soften it. And you know, it's not necessarily a bad thing for Apple. They have so many other sources of revenue. And frankly, I don't think that 30% App Store cut, I'd have to look at the numbers, but I think it's a couple $2 billion a year. I think they could afford to cut that down to 10 or 15 and be fine. So I'm not sure why they've taken such a hard line on the 30% number, but yeah, it's endlessly fascinating, like I said, to see it play out on Twitter.
Good stuff. So let's do some Q&A. And also I wanted to ask you guys something that I got as a question to a response on a Twitter post. I said, when I look back, it's the trade entries where I felt the most uncertainty and fear that turned out to be the ones that gave me life-changing gains, right? So when I look back at all the big trades that I've had, it's the ones where it felt just super uncomfortable at the time, but I had a lot of conviction, right? So it didn't feel good, but intellectually I had a lot of conviction. And I said, you know, it's usually when you're uncomfortable that you're profitable. And got some good responses and questions, but what I'm going to start doing is adding like this like AI art to a lot of my tweets. I just think it's so cool to kind of visualize, you know, what the point is that you're trying to get across. So here's like a guy sitting uncomfortably, like staring at price charts with like Bitcoins on the table.
Look at that AI hand.
That's cool.
Oh, I know, right? It's so creepy, the AI hands. Like everything else is amazing, and then you look at their hands and it's like, what?
They got to work on that.
Yeah,
yeah.
The rest is
but
great.
Yeah, I thought this was, you know, just an interesting idea. Like whenever I was thinking of this, I was thinking, you know, Bitcoin at 188 or Bitcoin at 3,000. It's like when you're buying in the depths of hell, it never feels good, but that's usually the most profitable time to buy. And then we got a question here from Raz saying, how do you cope with large drawdowns, right? So whenever the markets crash, if you're holding positions, you have big drawdowns. Do you just take small shots with wide stops, or do you just accept 100% loss on whatever buys you make in a bear market? So the question is like, do you take multiple stabs on the way down, and do you buy and get stopped out, buy and get stopped out, or do you like average down and build into a position size and just accept that like, hey, if this thing goes to zero, you could lose the whole position? Right. Those are kind of the two opposite ends of the risk management spectrum that somebody could have. How do you guys think about this? And then I'll give my answer last. But Trav, why don't we start with you, man? How do you think of this? Do you take a lot of small trades with tight stops, or do you give it a lot of room and accept that you could lose the full position?
So this is so funny because I have been updating the content in my course, the Hedge Fund Playbook, which is a free course that we're going to be opening back up again here shortly. And in that course, I talk specifically about when to average down and when not to. And there's some nuance to it. And one of the biggest things I think is not averaging down on something where there is a high probability of it going to zero. Now, if it also is about position sizing too, right? Like let's say, you know, you can average down on something even if there's a possibility of going zero, as long as you don't make it too big of a position, right? Like there is some wiggle room there, but generally you don't want to average down, for instance, on something like, you know, a super, super risky altcoin or a bank, which uses a lot of leverage, you know, going into a financial downturn or something like that, or going into a financial crisis, right? That's what people did in like 2008, 2009 and wiped out some of their funds was, you know, they were averaging down in Bear Stearns or Lehman or something like that, where there was still a high probability it could go to zero just because of the leverage. So one of the rules that I try to have is if you're, you know, try not to average down on anything that has a high possibility or probability of going to zero. So that means anything with a lot of leverage on the balance sheet, anything, you know, that has very, very, that's very, very unprofitable, or something that's just super, super high risk. So trying to avoid averaging down on stuff like that, especially in a bear market, is kind of one of the rules. Also, obviously, capping the position size on anything like that, where it's a, you know, much more risky proposition. But on the other hand, there are times, especially later on in bear markets, where you actually might want to average down on something because it is so washed out, the sentiment's so bad, and the risk reward has gotten so good that if it does succeed, even at a low probability, that it's going to be one of the best trades of a lifetime, right? And so getting that right is really difficult. But again, there's certain rules you can set for yourself, like position size limits on any one thing, and having the discipline of not averaging down on certain types of positions with certain characteristics. And that's how I generally think about it. But yeah, I completely agree with your tweet, by the way. That's pretty much all of the best trades I've ever made in my career always felt kind of uneasy in my gut as we were buying them. And I don't think I ever have made them as large as I've wanted to because of that reason. It's really hard to do.
Yeah, I mean, hindsight's easy, right? But when you're buying blood, it's like, okay, is this a value buy, or is this, you know, am I being reckless and foolish buying into something that could potentially be crashing all the way down to zero? And is it better to take multiple strikes, right? Like a few little small losses to get the grand slam, or is it better to build in and average down and get a bigger position size without taking those little strikes to eventually get the big swing, right? That's kind of the challenge. And I think for newbies, that's kind of hard. Nikki, how do you think about it?
I think the first step is figuring out if you're trading or if you're investing, because the strategies for that are very different, right? Like if you're trading and you have a big drawdown and you're trying to figure out if you should add to it or get out of it and you don't know, that might be a sign that your trade management going into it just wasn't there. Your trade plan wasn't there, right? And this is where people get into a lot of trouble. So with trading, I think it's calculated. It's more black and white. You know where price shouldn't go, and if it goes there, you get out and you take your loss, right? Your graceful exit, and you can always try the trade again later. Don't ever forget that. I've had many times where I've had to take a stop loss, take a graceful exit, but I try it again if it sets back up, and then it works, right? So don't be afraid to do that. If it's an investment, that's where what Travis was talking about really comes into play. And it also depends on what you're looking at. If you're looking at fundamentals, exactly what Travis said, right? It's very nuanced. It depends on what's going on with the company or whatever it is that you're investing in. And sometimes you're gonna take a big drawdown. Like you're gonna take a big drawdown if it's something that the thesis hasn't really changed much. The company's executing, things are actually like maybe people are overreacting in the market, but you're confident on your thesis. That could be an average down opportunity. But if things have completely changed, then that's something you really a lot of times are going to want to just take your money and run, and you can always get back in if you have to later. So I think the first step is determining if you're in a trade or if you're in an investment. And then the second step is, what are you looking at? Are you looking at fundamentals? That's a little more nuanced. If you're looking at technicals, that's not as nuanced, right? Technicals is more like, hey, if you're breaking support or if you're breaking these key levels, or if you're not holding the sweet spot retracement zone, we may have to double think this, and you just may have gone into this without a good trading plan. So that's my strategy and how I approach it. And the two are managed very differently.
Yeah, I think on both sides, you could just ask like a simple question, which is the reason that I got in this trade or this investment, is that still intact or not, right? If it's technical, you know, if it's fundamental, it's like I was buying because I thought this about the company or the crypto or whatever, and that has changed, and therefore my thesis is gone, and I'm gonna get out. And then to Trav's point, you know, just looking at stuff that has a potential for a zero, right? Like in crypto, this has been happening a lot recently, thanks to Luna and FTX and stuff, right? It is when you have a market dumping off, is it because it's imploding and it's dead? Or is it because people are overreacting and they're dumping and you still have conviction in the play, right? Like, think about what I said here. It takes conviction when it's uncomfortable to be profitable, but you have to be right. You can't look at this and go, I'm a lunatic, right? Like whenever these crypto communities like create these names for themselves and they identify with the project and they make their ego about the project, that's when you're more likely to make these dumb mistakes of trying to buy into what looks like blood, but it's really an implosion where this thing's going to zero or close to it. And I think the same thing can happen in stocks, right?
I just realized, do we have names for ourselves like Lululemon addict or like Tesla crazy person? Like, do we do that in stocks? I don't think we do that in stocks where we name ourselves based on the stock we're investing.
Oh, I mean, the apes.
Do we do that?
The apes and some of the meme
yeah.
stock.
Well, okay, to our point that you just made, like that the apes are the ones that name themselves in the stock market, and look what happened with that. So yeah, I guess like
anytime you identify with a tribe, you're instantly putting yourself at a big disadvantage, right?
Well, that's where the emotions get in the way. Yeah.
But yeah, so I think you guys definitely made some good points, and the answer is it depends. But a simple question you can ask is, is my reason for getting into this position still intact or not, right? And if not, you get out. If you're trying to catch small bounces, maybe you manage that with a little bit of a tighter risk profile. If you have a lot of conviction and you think you're getting better prices and you want to build a larger position size, that's where it makes sense to average down. And I love buying Bitcoin when it's down over 30% in 3 days. I made a shit ton of money doing that, and I'm going to continue to do that until it stops working. Maybe one day Bitcoin goes down so far that I do blow up a position on it, but I don't think that's going to happen. We'll see. Maybe somebody will clip this in the future and be like, "Ha, gotcha."
Just wait till GBTC gets liquidated, man, and everybody starts selling the 630,000 Bitcoins that are down. No, I'm just kidding.
Oh, shoot.
Yeah. I actually looked at that because I saw some tweets where people were worried about that some people believe, the Bitcoins are there. But the problem is that it's going to get liquidated if DCG goes under, and that means everybody's going to have all these Bitcoins to sell at once. But I was actually surprised to see that Bitcoin's average daily volume, even in like a low volume time period, it was only like 4 or 5 days of average volume. And actually in a higher volume days, it was, all of that could have been liquidated in a day or two. And so obviously, you don't want to be 100% of volume, but I was like, I think the market could actually at least absorb some of that supply. Now, would price be down? Sure. I just don't think it would be down like 90%, And so, that was interesting to look at as well, because there was a lot of fear over the liquidation scenario, and it didn't seem that big of a deal to me. But
Kathy Wood said that Bitcoin's going to 1 million by 2030, so maybe we don't have to worry about it.
There is a scenario where that happens. I don't know how to gauge the probability of that, but I mean, I know what the roadmap to 1 million looks like.
I mean, I will say, I talked about this in one of the prior episodes, that the whole FTX thing could push people more towards Bitcoin. And Kathy said the same thing. So
yeah,
I agree with her on that.
It's creating a supply crunch, right? And like, it's really fucking sad, because you had all these people that were watching, they were watching Tom Brady on TV commercials saying, yeah, just go buy some Bitcoin through FTX, right? Are you in? I'm in. And like, you had a lot of people that were like some of the biggest like financial YouTubers were pumping FTX. And so you had probably millions of people that were buying anywhere from very small amounts of Bitcoin, in quotes, to very large amounts of what they thought were Bitcoin. And FTX had fucking no Bitcoin, right? Like it's really, really sad. Like, this is just such a crushing thing to happen to people. But I guess the silver lining is that it's creating a supply crunch on exchanges. Like, people are now like, okay, fuck this. I'm not going to trust a centralized exchange anymore. I'm going to verify that I have these private keys. And, I don't want to beat this dead horse because we talked a lot about it last week, but I think it's worth repeating that there's a finite supply of Bitcoin. And when a lot of those get sucked off of exchanges and people hoard them, and if there is a sustained demand for those Bitcoins, limited supply, increased demand, we know what happens to price. So will that happen tomorrow? Will it happen a year from now, or by 2030? Who knows? But I just think that the tokenomics of Bitcoin make a lot of sense. And as long as people don't lose faith in that because of shitty ass companies like FTX, I think Bitcoin will remain on its upward trajectory over time.
Well, it's holding pretty well. I mean, it had that dip below support, but it came right back and it's holding. So that could be a sign that that's starting to play out.
Yeah, we'll see. I mean, I'm not convinced that this is the low yet. I mean, it could be, but I don't know. I haven't seen any signs of ultimate capitulation. Yeah, we had a pretty big dip back in early November. But we'll see. I don't know. I don't have a lot of conviction yet.
Yeah.
But yeah.
I was just surprised to see it hold. but
yeah. No, I mean, the fact that, look, I mean, it's been what, 3 weeks consolidating. So
yeah, like that was something I looked at and I was like, oh, noted.
Yep. All right, a couple more questions and then we'll wrap it up. Gabby was asking, what are your thoughts on fixed index annuities? This is a good one for you, Nikki.
Yeah, so a lot of people have been asking me about like life insurance and fixed income annuities, so I figured I'd address this. A fixed income annuity is basically, it's an insurance contract where you give an insurance company an amount of money, and in return they say you can withdraw X amount for the rest of your life until you die, basically. And it's a way to just to guarantee some income in your retirement years. But what happens, which I don't like, is a lot of young people get sold these index in annuities where it's an annuity, but it invests in the S&P 500 index or some type of index. And so you get some of the return of the S&P 500 and it helps you kind of be invested, quote unquote, but for very high fees. And that's what a lot of people miss. And these are very expensive contracts, annuities, and also they're not really meant for young people. People that are young and have a lot of time ahead of them to compound, it's better to just invest in the actual S&P 500 index fund, because the annuity, they're going to be taking fees and they're not going to give you a full return, right? So I think a lot of young people are getting sold these things, and they're getting sold, hey, you can invest in the market, your downside protection, and you'll have guaranteed income in retirement, but they don't realize that a lot of these contracts are just not well suited for someone in their 20s, 30s, or maybe even their 40s, right? The annuities are when you get closer to retirement age, you want to guarantee some income and use some funds to do that. That's when you do that type of planning. But I think a lot of young people are getting sucked into these things, and it's unfortunate.
That TikToker, we know who he is. And
yeah.
Curtis. And those are so high fee. It's crazy.
So high fee.
And usually front end loaded, right? I think, from what I've seen.
Yeah.
And so they take out half the money you put in the first few years is gone to fees. And so, yeah, you don't actually make that up unless you stay invested in that product for, decades or whatever. It's kind of a scam. I agree. I definitely am not a fan.
I just think that if you're young and you hear the word annuity or universal life insurance or any kind of life insurance that's not just term life insurance, you need to stop and you need to do your research. Don't get sucked in to that.
There's a lot of guys that make a lot of money selling these plans as ultra rich do.
Yeah, and it has a time and a place, but that's the problem. Ultra rich people do it for a specific reason. If you're not ultra rich, don't do that. It's not going to work the same way for you.
Yeah, the problem I've heard in those pitches is they're like, yeah, even if you have $50 a month to start investing, you want to start with this one. It's like, no, there's like a series of events where you start with this type of account and then you move on, right, Miss Financial Planner?
You're going to get me heated. Continue.
That's a topic for another show. We're pushing an hour. So, we'll cover that one. We'll dunk all over the high fee salesman in the finance space. All right. Look, guys, a lot of economic data coming up later in the week. Do you guys foresee any surprises, or do you think we're going to be bullish, bearish? What are you guys thinking?
Yeah, it's going to be interesting. So we have unemployment data this Friday. We've got the ISM manufacturing, I believe, on Thursday. And then, those are pretty big pieces in their own right. We tend to have a lot of leading indicators. So I don't think we'll be super surprised by the unemployment report the way that we get surprised with CPI reports. But we do have another CPI report the following week. And then we get the Fed meeting in about 2.5 weeks. And so those are going to be obviously monumental. And I think the CPI, from what I've seen, should continue to trend down. But who knows what happens with the Fed meeting? I mean, we think that it's going to be a 50 basis point hike, but we don't know what kind of language is going to be said at that meeting about hikes into 2023. Some Fed speakers have been softening their speech. So that's a big event where there's going to probably be a lot of volatility. And so that's going to be one to keep on your calendar as a, hey, if you're actively trading, this could be a big day. So we'll be obviously tuning in for those. And as far as the Fed policy is concerned, I'm very interested to see where we go from here, because I personally don't think they need to do a whole lot more. I think they need to chill out for a bit, but they are going to do what they're going to do, and the market may or may not like it.
Yeah, I mean, they could see low unemployment and maybe a strong-ish consumer still as a way to keep going. They're going to take the runway if they have it, I guess. But yeah, it's a huge question mark right now.
Well, we'll look forward to that next week. And yeah, kind of a pivotal area in the stock indices as far as the charts go. Bitcoin obviously still testing support. We'll see what unfolds over the next couple of days with GBTC. And yeah, just a lot to look forward to for next week. So guys, thanks for all your questions. Go to wetalkmoney.com to submit a question for the show. Also, wetalkmoney.com/community if you want to check out our wealth building community. And Trav and Nikki, thanks for being here and all your wisdom. And
absolutely. Thank you.
Yeah. We'll see you guys
next week. Watch out for us on Twitter Spaces soon.
Let's do it. Twitter Spaces. Yeah. If y'all have any suggestions of what topics you want to see us cover on a Twitter space, add us on Twitter at She Talks Finance, at Stock Geek TV, at Chris Dunn TV, I think.
Yeah, that's right. But it really doesn't matter because Twitter's going to be bankrupt next week anyway. So
no,
Papa,
that'll be a good one to talk about. Papa, no. All right, guys. Thanks for watching or listening. Subscribe to the audio podcast and the YouTube channel. Like it up, share it with your friends, and we'll see you next time. Take care.